Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, I don't want to sound like a broken record, but we are going to talk about inflation again. So this week, the December inflation data came in and the consumer price increased 7% year over year. That's the largest gain since 1983, and it's the third month in a row where we have seen an excess of 6% year over year on inflation. So let's talk about how this affects stock valuations.
Yeah, Steve, well, let's look at the most popular metric, which is the PE ratio, or price to earnings ratio, for the S&P 500. Currently, the trailing 12-month PE ratio for the S&P 500 is around 24. So the index is trading at about 24 times the last 12 months' earnings on the companies in the S&P 500. Historically, if you look at valuations and inflation, when inflation exceeds 4%, you've seen what's called multiple compression, and that's where that PE ratio shrinks. So historically, if inflation is somewhere between 4 to 6%, the PE ratio on average for the S&P 500 is around 15, below that 24 we just pointed out. When inflation is around 6 to 8%, the PE ratio shrinks on average to around 11 times earnings. So we know the future is not going to look exactly like the past because we're just in different environments, but it does serve as a guide for what we might expect, at least the direction of things to go.
You know, Travis, you've talked about this in the past. So we know the S&P 500 is top heavy. According to Goldman Sachs data, 5 companies, Microsoft, Apple, NVIDIA, Tesla, and Alphabet, also known as Google, have contributed to 51% of the S&P 500's returns since April.
Wow.
If you go back to the beginning of the year, those 5 companies are responsible for 1/3 of the entire index's returns.
Yeah, so let's expand the universe, Steve, and look at the entire large cap universe and just the other side of the spectrum here. Over the last 3 months, 6 stocks in the large cap universe have lost more than 50%. 35 stocks have dropped somewhere between 30 to 40%, and 62 stocks have lost somewhere between 20 to 30%. So returns in the large cap universe between the stocks I just pointed out and your 5 have been very uneven in 2021.
So true. So Travis, if you were concentrated in the S&P 500 over the past few years, it's easy to see that that has paid off. But considering the uneven performance, we are talking about the above average PE, and you pointed out, and the sharp inflation data that we just saw. Where do we really go from here?
Well, Steve, at this point, it probably makes sense to look beyond the S&P 500 for returns. I mean, there are various strategies, whether they're active management or alternative indexes that aren't as concentrated at the top like the S&P 500 are, that will allow you to take advantage of some of those unloved companies that haven't performed as well to this point, but are still good companies. Also, don't forget to look beyond the U.S. for return. It's easy to get caught up in the U.S. because of the performance the past few years, but look beyond the U.S., developed international and particularly emerging markets, although they're going to be more volatile in your portfolio, are going to provide more opportunity for growth moving forward.
Can't agree more, Travis. This has been great. I look forward to it next week.
Look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.